It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. Welcome back. Welcome back. Welcome back. Was that a song from the 70s?
I don't want to hear it.
No, I don't want to hear it either. Anyway, Johnny Dean here, Professor Rick Plum. We're welcoming ourselves back because we've been on. We do
little
this hiatus for we take 2 to 3 weeks. Usually, we finish about 12 episodes of our podcast, and then we reset, get some more topics.
Take 3 weeks off and then come back.
Yeah.
We're back.
Sometimes it's 2. Sometimes this time it was 3. I've been out of town. I had a wonderful vacation with my wife. 35 years of marriage that we celebrated out in Italy and Germany and Austria. But anyway, so I needed the full 3 weeks.
Wow. I went to El Centro.
El Centro.
No, I didn't because it's too hot there right now.
Who's going anywhere at this time? It was weird to come back from this because where we are, we're in Southern California. It's in the high 90s. It's going to get into the hundreds for a couple of days here. But where I was, I don't think it ever got over 70. So it takes a little getting used to. Anyway, we welcome ourselves back. We welcome our listeners back who are probably just about getting caught up with the amount of episodes that we have. This is Managing Your Financial Future, and this is what we do. I want to talk today about something that sort of underscores why we do buckets. Now, I know we've talked about buckets quite a bit over the last...
It's what we do.
But it is what we do, and there are different angles to it. And sometimes you get people who sort of think that they can, I don't want to say they can beat the system, but the point of all this is that time is what matters. Now, I'm going to read this to you. We get this feature called By the Numbers, and we've been getting this for years. Although I'm told it's ending now.
That one in your hand right there is the last issue. It comes out weekly.
Yeah.
It's a series of 10 to 12, 15 bullet points about the markets, generally the numbers. I mean,
sure.
The market was up, and there's one in here that, over the past 20 years, the market's up 53% of the time, 47% is down.
Yes.
Just things like that, just straightforward numbers. And it's great research. Unfortunately, the gentleman that has been doing this is retiring.
I think it's Mick Higley. I think
couldn't
that's his
say.
name, I believe. And
he's done a great job.
He's been sending us stuff for a long, long time, but he's retiring, so I don't know what we'll do after this. You mentioned that one. Let me just bring up that one bullet point, because these numbers really don't lie. This was his favorite bullet point of all time. You mentioned this. There's a 53-47 split between up and down trading days in the U.S. stock market over the last 50 years.
Oh, 50 years. That was further than I thought even.
Since 1972 through 2021, there have been 53% of the time each year. I think he means the S&P.
Yeah,
S&P
he does
500.
base most everything on the S&P 500.
Yeah.
The index itself, not like a mutual fund S&P, which includes dividends. He's talking specifically
the actual
just
index
the index
itself, which you can't invest. You can't
invest directly in the index.
No, you may not. So 53% of the time, the index was up from January 1st to December 31st, and 47% of the time it was down. Now, that seems like an almost even split, doesn't it?
And it's interesting because I've been, it feels like when it's down more than it's up.
Well,
at least at a percent per day. So you would want to have a lot more up days to counteract those down days.
But so you've got up, you got down. It seems like, there are only a few more up days than there are down. And yet, despite what they call near every other day volatility, the S&P 500 still generated an 11.1% per year return over the last 50 years.
Right. And
positive. 11.1% per year return. Again, this is according to BTN research.
But what I read, it's a bumpy ride.
It is a bumpy ride.
As we've been finding this year.
Well, we have. And
I was looking at different months, and August was not a good month. July was a good month.
It was pretty good.
June was a horrible month. It was like Man.
No, this is the kind of volatility that we see, and the kind of thing that you really want to avoid, because when you react to volatility, as we're going to see, things can get very bad for you very, very quickly. All right, so you have that particular number. The one I want to focus on here, though, has to do with this. This is what this gentleman sent, and he had a comment. He says, the bullet point that had me shaking my head every year when I updated it, compared the fortunes or misfortunes, they say, of two retiring individuals exactly 9 years apart in age. So let's say one is about 65 and the other one is 56. Okay? So the 65-year-old, the first person has $1 million, and they invested 100% of it in the S&P 500 starting on January 1st, 1973. Now,
$1 million in 1973, they were rich.
They were rich, and if that's all the money they had and they were retiring, it was a bad move.
Well, anytime, if you're retiring and you're looking to take a distribution and you're 100% stocks, you're looking for trouble. But he's using this for an illustrative point.
This is an illustrative point, exactly. So this person invested $1 million in the S&P 500, we said you can't invest in the index, but
well, he's using the returns of the index.
Correct.
You can invest in mutual funds that use the index as a guide, and they try to match the percentages fairly closely.
Right.
And actually, mutual funds can do a little bit better because when you're owning the individual stocks, you're getting the dividends if they have dividends. But there's also a little bit, in many cases, of an expense charge that'll take a little bit out of the way. But
but anyway,
it is what it is.
Oh, okay. So, but you invest $1 million as of January 1st, 1973, this individual, and they decided to withdraw an inflation-adjusted $100,000 per year. Now, that's a 10%, 10+%.
10% of initial value distribution.
10% distribution, which is...
It's ludicrous.
You would never do this. No advisor would.
I mean, if you're 95, 100 years old, you could, maybe get away with it. But
maybe, especially if you didn't care so much about your heirs.
Yeah.
Okay, but that person who did that seems kind of reckless, would be out of money in 9 years. So if they continue to do that, that account would be empty by December 31st.
Even though you're taking 10%, which you think, I could get at least 10 years out of this.
You don't even
Plus
get 10
whatever
years.
the market grows to, you're out 9 years.
Right. By December 31st, 1981, that person's account was done.
Done.
Out of money completely. Okay. Yes, that was probably risky.
Very reckless.
Okay. So that's on December 31st, 1981. So the very next day, January 1st, 1982, so this second person, who is now 65 years old, retires.
And
they
does
also,
exactly the same thing.
They also have $1 million. I guess they thought they knew what they were doing.
Well, they sure didn't inherit it from the first guy.
They didn't. So the person on January 1st, 1982 says, I'm going to do the same thing. I got this $1 million. I'm going to put it all in the S&P 500, and I'm going to withdraw $100,000 per year, inflation adjusted, 10% withdrawal rate. And they decide to do the same thing.
Now
remember,
clone.
Right. Now his buddy, I assume, was out of money in 9 years. This person who did this starting January 1st, 1982, instead of January 1st, 1973.
They continued taking that 10% of initial value distribution plus inflation.
Right. Do you know how much they had? They were not only not out of money.
They weren't out of money in 9 years. They weren't out of money in 19 years.
They still have, after 40 years.
So they made it to 105 based on our numbers. And they had what? $5 million?
$7.72 million remaining after 40 years of taking this out. Now, okay, this requires some explanation because it seems odd to some people.
Well, you've got one person. The strategy they both employed was exactly the same strategy.
It was a gamble for sure.
Both sides were a gamble. And what happens when you gamble? Sometimes you win. Sometimes you don't win. The first person, or the earlier person, this one, didn't win. They were out of money in 9 years by doing this strategy. And this strategy is not too far off of what a lot of people do employ.
Exactly.
Although they don't use 100% stocks. They use more of a balanced portfolio that they come up with. They take 100 minus your age, and that's how much you have in stocks, or that's how much you have in bonds. I can't remember which way it goes. But you have some kind of a conservative balanced portfolio. And while it lasts longer than what this gentleman did, the balanced portfolio doesn't last in every situation either.
No,
but this is done to illustrate a point. In 1972,
73.
It's 1973. Nobody had anyway. We had ideas of what the market should do. The markets historically do, as we mentioned earlier, 11% over the last 50 years, as measured by the S&P, 10% depending upon. But typically, when you look at long-term averages, the market as measured by the S&P or similar, does 10-ish%.
Mm-hmm.
So why can't I take 10% a year? That's the rationale behind this. And so it doesn't always do 10%.
Well, it might do 12% one year, but then be down 9% the next year. And
last
then up
year,
20%.
Last year was up like 28% or some number, the high 20s. Yeah, well, wow, that's awesome. This year's not so much.
We'll see how it plays out, but yeah, so far.
But that type of up and down movement has a huge impact. Mm-hmm. And depending upon when you start to distribute money from the portfolio, when you decide you want to retire, the next several years has a major impact on whether or not your portfolio will survive if you're using this type of an approach, whether it be an all equity approach or a balanced approach for that matter.
So the next few years.
And it's, what happens 30 years from now is not the issue. What happens in the next 5 to 10 years, from 72 to 82 was not it was fairly volatile times. We had a fairly large drop off in 73. I think everything was peak to trough about 45% or so. And it took a long time for the market to recover. But then the next person who started their retirement in 1980,
82, yeah.
The next 20 years were, for the most part, very good years for the market. So what are you going to face when you retire? Are you going to face a 72, 73, 74 type of market or an 82 to 2000 type of market? Nobody knows, because back in 72, a lot of people felt that the markets were going to continue the way they'd been doing, fairly, consistent. But things happen.
And here's why this math works out the way it does. Because if this person has to have $100,000 per year and their $1 million gets cut after a few years to just $600,000, you're taking $100,000 out of a $600,000 portfolio. That's more than 10%.
Quite a bit, yeah.
On the other hand, on the other side, if you're taking $100,000 out of $1 million portfolio that has grown to, say, $2 million,
now you're down to a 5% distribution, which is almost reasonable.
And when maybe it goes up to $3 million or something. Now you're down to 2.5. This is why they won't run out of money.
Right. At some point, if you experience positive results over the first 5 to 10 years, your portfolio has grown and thereby reduced your distribution rate as a percentage of the overall. On the other hand, if you face a series, even a couple, and they don't even have to be minus 45. So just minus 10, 15, even a 20 there, you're going to face some problems because, if we take that $1 million and we're taking even a 50,000 a year, 5% distribution, but we face a 20% downturn in the first year. Now you're $1 million turned into, 800,000, but you also took 50,000 out of it. Easy math says, well, I'm down to 750, but I still need 50,000. Now I'm taking a much higher, that's, distribution, the 7-ish% from that portfolio. So it has to do at least 7 just to break even.
Exactly. Yeah.
And what if it doesn't? Now I'm going in the hole further.
And that's why this one person ran out of money in 9 years, while the other one is still going way strong after 40 years.
So when you do this type of a distribution, whether it be a all stock equity, which I think is very reckless, or even a balanced portfolio, which I still don't think is the right way to do it, you run the risk that you are going to look at your portfolio and say, these first couple years of my retirement, the market, which you have no control over, has not done what I needed it to do. And so the one thing I do have control over is how much I take out of the market. So I'm going to cut my retirement.
Ooh.
That's no fun either.
Well, what if you can't? I mean, you have bills to pay.
Well, I mean, you have to try to figure out something. You have to cut something. Maybe you don't travel as much. You don't see the grandkids. You don't help the education. All the things in retirement that people talk about wanting to do, they now can't do it, or they have serious anxiety. I've seen where people get into a situation where they're funding too many things and they have serious anxiety about what's going to happen. They feel bad that they want to cut their spending, but they also feel bad about not spending what they promised somebody they were going to do, education, or whatever the case may be.
Well, the solution, Rick, is to only retire when the markets over the next, say, 5 years are going to be going gangbusters.
Right,
Now,
but
what's
you've got
the
to
problem
predict
with
the
that?
future of that next 8 years.
You can't do that. Nobody can do that. So this is a dilemma for retirees, and it's one of the reasons we kind of hammer this home. I mean, you could either turn out like this person who was out of money in 9 years, or you could have done the exact same strategy, gotten lucky, and be somebody with not just $1 million or $2 million or $3 million after 40 years. They got almost $8 million doing it this way. It's gambling more than anything else.
When you're putting yourself in a position to withdraw money or want to withdraw money from a portfolio that has volatility, it could work out very well or very poorly for you. And poorly is the operative word there, because you would be poor. Mm-hmm. And that is not very much fun. So, I mean, it's just a matter of, can you predict the future? And even if you went with a more balanced approach and you went maybe a 50-50 stock bond mix, that you stayed balanced every year, and you started about the same time, you still would have had issues with your portfolio. Take somebody who retired in 1969-70 and only took a 5% distribution.
Right. And they had a 50-50 mix of stocks and bonds.
They were out of money in 20 years. So, yeah, it worked a little bit better, but they not even inflation index, taking just 5% a year out of the initial value. They were out of money in 20 years, but somebody who retired 10 years later had gobs of money 20 years later.
So again, it's
hit and miss.
A coin toss here. It's gambling. I mean, most people don't want to gamble with their retirement funds, I would expect. But you can't predict what the next 3, 4, 5 years are going to bring in the stock market. You absolutely cannot do that. Sometimes you have no control over when you retire. You retire when you retire. So, Professor Plum,
and even if you do have control over when you retire, you don't want to have second thoughts 6, 8, 10 months later about, this year. You were going to retire January 1st, 2022. Yeah, everything was looking rosy in the market at that point. And now how are you feeling?
maybe you rage quit, because you're 65 January 1st of this year, and now you got to come back to your former colleagues and boss and hat in hand, like Oliver Twist asking for more gruel. Can
I have some more, sir?
Can I have my job back, please? You don't want to do that. So obviously we're being funny here, but the point is very serious. You can't predict. Absent of being able to predict when the market is going to be up or down,
and how long it's going to be down,
the only thing you can do is to strategize. You have to take the gambling off the table, Professor Plum. Am I correct?
Or at least as much as possible.
As much as you possibly can, control it.
Right. I mean, the markets, we know we cannot control what the markets are going to do in the next year, 2, 5 years, whatever. We can't control the markets at any time.
Nope.
We can control how we use the markets for our financial good. Do we use them for our immediate cash flow? Not unless it's in a positive zone. So how do we set ourselves up so that we never have to be selling assets to create the cash flow we need when the markets are doing what they've been doing for 2022?
Well, to avoid the potential of being out of money in 9 years, or
whatever year it is, to avoid the potential of being out of money at some point in your retirement, or reducing your money to a point where you're worried about it, and you change your retirement and you change what you're doing, you basically letting the market control what your life is all about. You've got to find a way to do that. So you've got to find a way to, we still want to use the market for longer term investing, just not short term. You want to match your assets and liabilities.
So given that, what would you have done to these two individuals? How would you have taken, they have $1 million. What would you have done with this individual's million? First of all, I would tell them that 10%.
Well, 10% distribution is very difficult to deal with.
Yes.
Because that's just a very unsustainable distribution pattern.
Well, potentially, unless you happen to get lucky, right?
Right. And that's a key word there. Are you
okay?
Well, do you feel lucky, punk?
Do you?
Sorry.
Yeah. Were there 6 down years or only 5? I lost track myself. So what would you have done? How would you have mitigated the risk for both of these individuals, and I know what the answer is. I'm leading into the whole buckets idea.
But
what would you have done for this with this person's $1 million? How would you have advised them to potentially invest?
We would have said, you need to put some money on the sidelines, money that is not going to grow very fast, money that is safe by nature, cash, CDs, and things of that nature, or relatively safe, maybe a bond ladder, which is in many cases is they're insured, but something that does not have the market fluctuations that I can draw down, that a dollar is a dollar. So when I pull that money out over the next 7-8 years.
So off the top of your head, what would you have told this individual? They came to you and said, got $1 million. What am I going to do with this?
I haven't done the math on this, but
no, I know. But
let's just make it real easy. Let's put a third, $330,000. That's only 3 years. See, 100,000 is tough to deal with.
Well, first of all, I think what you might say
we would have to have
10%
a very
is too
big
much.
discussion on 10%.
We're going to have to cut this down. So let's say you can convince them to do something a little bit.
Let's go more realistic and do 5% or something.
Tell them you can't retire on 10%.
You are going to run out of money if you're taking 10% of distribution,
or you're running a huge risk.
Yeah, that's a better answer. But because there have been, as this is illustrated, there have been time periods where it did work.
So first thing you would do
be
is
a lot more conservative on the portfolio. We would talk about the distribution pattern, and the other you have to get away from selling assets when they're down. I don't know. I know that the market in 73, 74 was really bad, but it did come back. Now, did it come back all the way? Even if all you did was put, half of the money in the cash and left the other half pure stock, you have 5 years for the market to crash and at least recover somewhat. And in the 72, 73 downturn, you would have recovered. I don't know if that 500,000 you left in the market would have come back to 6, 7, 800,000 or not. But it would have still been, the 500. It would have gotten you at least another year or two. By being more conservative, you made your portfolio last longer. Now, did it solve the problem of 10%? No. One of the problems here is A, they retired at a bad time, but they didn't know it. B, they're taking too much money, and that they did know.
Yeah. So you would have first of all said, let's cap this.
Too much.
Let's cap this at, let's call it 5. So you have $1 million. I'm not going to give you can't take $100,000 out per year and expect it to last very long unless you get really lucky. So you would have probably told them, am I right? You would have said, let's make this $50,000. If you can't live on $50,000, then you probably can't retire.
It's a hard discussion to have.
Right.
And thankfully, we don't have to have them very often, but we do have those discussions from time to time.
Let's say you can get them to go down to $50,000.
Right.
So now what would you do?
So now we're going to take $350,000, give or take,
of their million,
put it into very safe assets, and we're going to draw principal interest out of that for the next 7 years with a little bit of interest left over.
So you're going to buy them 7 years of time where they take $50,000 per year out of income.
Well, if at that rate, because 5 times 7, 50 times 7 is 350. If you just put it in the bank, the bank will guarantee that you've got that. Okay, I'm not going to guarantee anything.
Well, but I mean, can I use the G word?
But you know that you've got that for the next 7 years. Then you take another 300,000 or so, and you put it into a midterm. This is where the balanced portfolios do their job. The balanced portfolio, stock bond mix, where it's all reinvested. You're not taking distributions. You put it into a portfolio that could go down. But in historical terms, we haven't seen them go down and not recover during that 6-7 year time frame.
So you've bought them 7 years. They're cool for the next 7 years.
What we call bucket number 1.
Right. So they're cool for the next 7 years. They got the income they need. Maybe even a little inflation adjustment. Yeah. Maybe
a little.
No, we'll see.
Back in 72, didn't they have Reg Q or whatever that said we could earn 4 or 5% on bank accounts?
Yeah. Yeah. Let's just say maybe a little inflation, but whatever it is. You've bought them 7 years, so now you have to figure out what's going to happen in year 7.
Yeah, we need to refill bucket number 1.
This bucket's going to be empty.
But 7 years is too short of a time horizon to really rely heavily on the market. There's still a chance, and it's maybe a 20%, 25% chance, but Murphy's Law says you'll find that 20% chance that the market hasn't recovered all the way and given you a positive result over that 7 year period of time. So let's use a moderate portfolio, balanced portfolio, and then in 7 years, take what's in the balanced portfolio and refill bucket number 1 and refill it with more than what we had to begin with so we can get a nice inflation bump at that point and buy another 7-8 years worth of distributions.
So you've carved off of their million, 350 plus 300? What did you say?
Yeah, give or take, yeah.
Okay, so you've taken 650, and none of that is going to go into an all-stock allocation,
Nope.
right?
Nope. There are other types of investments besides balanced portfolios, but you don't want to have the pure risk of the market. And so you want to have something that earns a little bit more than cash, but it's not going to earn as much potentially as the stock market, but also doesn't lose as much as the stock market. It doesn't have to recover as much as the stock market.
Well, that only leaves what? $350,000. Are you going to put $350,000 of their original million
in the stock market?
Now, rather than put a whole million in, you're only going to put $350,000.
Right, but I don't have to worry about touching that last 350 for 14, 15 years, because bucket number 1's covered the first 7, bucket number 2's covered the next 7 or so.
So you've got your income for the next 14, 15 years.
I don't have to touch it. Doesn't mean I don't touch it. Maybe if I go through a period of time where the markets are just on fire, I can always use the growth of that market, of that bucket. But let's say the markets go through a 72, 73, 74 downturn, but they recover 15 years later. What does that 350 worth now? Well, if we assume the stock market, what do you want to assume? It does 10%. The math is easy this way as well.
All right, let's just say it did 10%.
Okay.
Per year on average.
On average. It might
Not
have
every
been
year.
down 20, up 20.
Right. But over 15 years, let's say it did 10%.
Over those 15 years. Rule of 72 says it doubles in every 7 years at 10%. And so by 350 in the first 7 years grows to 700. The 700 grows to $1.4 million after the next 7 years. So I now have $1.4 million that I can play with.
You've got $1.4 million. You've been retired now for 15 years.
Yeah.
You've taken an income for the last 15 years, and let's just say both of those accounts, the bucket
They're gone.
1 and bucket 2,
bucket 1 and bucket 2 are gone
because you spent them. That was your income that you need. But you look and you say, well, bucket 3 now, if in this hypothetical scenario, has $1.4 million.
Right, and this is just hypothetical math, basically. Rule of 72.
It's just illustrating. Sure.
Yeah, and the reality is, we probably don't want to wait 15 years to refill either 2 or 1.
No.
We are looking for opportunity to refill bucket 1 or 2.
To buy yourself another year.
To buy ourselves more time.
Yeah.
And that's when the markets are up more than expected.
Yeah.
So if the markets did what they did from, call it 2015 to 2019, we should have been refilling and pulling some of that cream off the top of those 20+% years in the market. Okay, 2018 was down. We didn't do any refilling then. But 2019, like we mentioned earlier, the S&P was up 27, 28%, whatever it was. That's more than most people expect. And if you're expecting 28%, you're delusional.
Okay, so you've done this now. Now you've bought them 15 years worth of time. After 15 years, in this, just using the easy math hypothetical scenario, after 15 years, their million is now worth $1.4 million. Call it, right? They've done pretty well. And do you now redo the buckets and give them another 7 and 7 years?
Yes.
How do you do that?
Yes. Like I said, though, you're always looking for reasons to it. But if you haven't done it and bucket number 1 and 2 are gone, do it again.
You're now 80. Okay.
Right.
You've bought yourself 15 years worth of, you retired at 65. The individual's now 80. And now you're going to buy them more time out to age 95.
Sure. That's how buckets work. In the basic form.
Oh,
yes.
Sure. No, this is very basic, just to illustrate the point of how this works. Now, here's the thing. If you did this for the person who retired in 1973, they'd probably be very thankful knowing that if they'd gone the other route, they would have been out of money in 9 years. But after 15 years, they're still going strong. They have an income, and they have $1.4 million in their
portfolio.
In their portfolio. Now, here's the thing, though. If you'd done this to the individual who retired January 1st, 1982, and after 15 years they had $1.4 million sitting in there, if they had done any math at all and they had been able to figure out, where they would have been had they taken the gambling route, it's likely that gambling route would have left them with far more than $1.4 million in their
for the person that retired with the
in 1982.
Positive markets going forward.
Right.
Now I haven't done 72 and 82. I've done some math on a balanced portfolio for somebody who retired in 69, rebalancing 50-50, and somebody who retired in 79.
79, yes. We have done that one.
I have done, and all I did with that one was, instead of using a balanced portfolio And this was one where the balanced portfolio was empty after 20 years for the person that retired.
19, I think.
Yeah, for the person that was retired at the wrong time. And they ended up with, 30 years later, they had $670,000, or their portfolio was 6.5 times larger than it started with 30 years later when they retired at the right time. I played the game and said, well, let's make it really simple. Forget this 3-bucket thing. Let's just do half and half cash, half portfolio. And the person that had the positive retirement date where they had nothing but money left over, they did have less money by going the buckets approach. They had about 20% less. So instead of, I was using $100,000 starting value. So instead of having 680,000, they had like 500 something thousand.
Okay.
But they were still quite up from where they were. They weren't up as much. But most people, if you gave them a choice of saying, would you rather take a chance of being out of money in 20 years or having 5 times the amount of money versus having 6 times the amount of money 30 years later, which one would you rather take?
Well,
the 5 times and not running out of money, or the 6 or 7 times more money than you started with, but having a chance of running out of money?
Yeah. See, if you take the risk, I don't want to say take the risk off the table. If you mitigate the risk, I think most people would say, I would rather not have the risk.
I want to reduce that risk of running out of money.
The scenario that you mentioned was a 50-50 for both.
Right.
This is 100%
stock. Yeah.
Stock. So I have a feeling that the person who retired in 1982, if they had gone the gambling route, would have quite a bit more than.
Well, yeah, the 100% market would be even better.
Right. So, but it doesn't matter.
But you just don't know what's going to happen. And this isn't a one-time thing. I mean, if you'd retired in 99, 2000 versus 2009, those are huge difference in returns. Because the person that retired in 99, they're not doing so well even by 2000.
Because we had a bad 10 years from 2000 to 2009. Yeah.
And that 20-year period of time, we had a couple of bad time horizons if you're distributing money from it. But from 2009 so far, it hasn't been 30 years, but we've had pretty good luck in the market up until recently. Even the downturns that we had prior to this year were relatively short-lived. I mean, so
what this does is it gives them the factor that we've talked about, I believe.
Right.
And if you take the chance of saying, look, here's the deal, you could wind up with the money, but you're going to be gambling. Would you rather forget the idea that you could potentially have more money and take the risk off the table by doing this? Is buckets correct, Professor Plum?
Right. It takes the variability of ending consequences and lessens them. It brings down the high end a little bit, and it takes away the bottom end quite a bit. So it takes a lot of the risk off the bottom. And of course, you're going to because you're not being as aggressive in the perfect world that some people think that they're retiring into. It takes some of that great return away because we're not 100% in the market.
Yeah.
But that's both a good and bad thing.
Well, I mean,
and if you can tell me exactly what the rates of return are, not just on average over the next 10 years, but each given year, if you can tell me what those rates of return are going to be
100% correct.
Right. Oh yeah. And
you
actually
have to be
right.
100% correct.
People asking, they've got the old adage, I want my portfolio to last as long as I do. I want my last, this is going to show some age, check to bounce,
as you write to the Undertaker.
The one to the Undertaker to bounce. We can show you, at least get you close to that date. If you give us one piece of information you haven't provided yet, give me that date.
Give me the date you're going to die, and then we'll be able to run you out of money.
You cannot, because you don't know. You don't know when you're going to die, but no, you don't know when the markets are going to be up or going to be down. So, it's just a matter of, in late July, people were thinking, hey, the markets are coming back. We're feeling good. Things are going pretty well. And then somewhere mid-July or mid-August somewhere, Powell comes out and says, there's going to be pain before we get through this economic condition. We're going to raise rates more. And August stunk to high heaven.
Did it? I've been gone. I didn't really see. What was the? Did you
Powell.
get the final numbers from August? Do you know what the S&P?
I didn't. I haven't. I know they were down.
I heard the Powell comments, but I didn't see what the.
I haven't done the math.
So August 1 to August 31 was down.
Yeah. Oh yeah. And July 1 to July. Well, yeah, just the last 5 days of August, it was down like 5% just in those 5 days.
Okay.
6%.
Yeah. All right. Well, when you step out of it, you don't pay any attention to stuff like
but
that.
July 1 to July 31st was a positive. It was not as positive as June was negative.
People who are listening to this in October are thinking this is old news, but that's okay. The reason we're bringing this up, as we have in past episodes, is to hammer home the point, folks, for you folks listening to this podcast, that taking care of business, planning for the worst and hoping for the best is really what the buckets thing is all about. Did I say that correctly?
It is the ability to create a stable income. And one of the criticisms of buckets is that it's too complicated. It's too hard to do.
Yeah, I've heard that before.
But it's not. I'll give you two answers to that. One is, even if it is, and I'm not necessarily going to go that way, is it doing the right thing to do in the first place, whether it's a little harder or not?
Yeah.
And the second part of that is, it may be slightly harder, a little bit harder to set it up originally, but when we go through years like we're seeing this year, where the markets have been a little negative volatility, having a strategy, one that anticipated these types of events, having a strategy where the income cash flow, the cash flow that you're taking, and having discussions with people that you don't have to worry about this right now. You've got 7 more years before the markets need to be your friend again.
Yeah,
it's much, much easier to deal with a bucketized individual over these types of periods than a balanced type of investor where, you could need to make some significant changes on your spending.
Yeah.
So I think it's a lot easier to do it the first time and follow through on it, because it makes everybody easier for the retiree or the person taking the distribution.
And isn't that what it's all about in the first place? When you retire, do you really want to worry that you're going to run out of money in 4 years?
No.
I don't. I don't want that.
I don't want to worry about running out of money ever.
No, but I mean to just see the specter of this and say, I retired and the markets are down 30%. I mean, they haven't been this year, but in years past they've done 2008.
Yeah.
Where we lost, what was it, 30 to 40%, something like
45-ish, 43.
Right. And to think that, this cliff that you were trying to avoid is now you're headed right toward it.
But also having a strategy that is in place, and it allows you more rational investing, so you don't sell out of the market that's down and basically solidify your losses.
Strategy, that's what we do. Buckets, if you need some more information, you can talk to Professor Rick Plum or any of the Lucia Capital Group advisors, whom, by the way, we're going to be bringing on. I was just talking to Jonathan Savona. Remember, we had him on
month and a half, 2 months ago?
Whatever it was, yeah. One of our episodes in the previous season, if you want to call it that. He has some great stuff. He wants to talk about, I'm going to have him back with you and talk about things like what they sometimes call an integrated financial plan.
Right, that looks at multiple. It's not just the investments.
Yeah, so we're going to be talking about this. If not in the next episode, then maybe 2 episodes from now. I'd like to get him back on, because this is the kind of thing that people can expect if they've never used an advisor before. It's I think good to see what an advisor at least should be offering to you. And I'll leave it at that. But I'm going to have Jonathan talk about that coming up. We've got other advisors, too.
Yes.
I'd like to have Janine Stripe on.
Oh,
It's
yes.
been a long time since we've had her on. Who are the others?
Well, we can get Terry back on from time to time.
Terry Keys, who's a busy guy. But
get my buddy Preston on here.
Sure.
He's so busy working. It's hard to get him away for an hour to.
Well, we're gonna do this. Some of these guys are a little shy too. They're more comfortable sitting face to face with a couple of people than talking behind a microphone.
Face to face to us.
And potentially talking to millions of others. Anyway, you want more on this, talk to Professor Plummer. As I said, any of the Lucia Capital Group advisors. Give them a call, 800-644-1150, 800-644-1150. You can also go to luciacap.com, LUCIACAP.com. Find a lot of this stuff that we talk about online. You can read blog posts. You can see videos featuring Professor Plum and some of the other advisors, luciacap.com, or give them a call. Talk to them about at least the potential of your portfolio from running out of money before you run out of time. 800-644-1150. Also, you can subscribe to this podcast. Spotify is where we are. Spotify. Download and listen to these. We have a lot of folks who are doing that, and we appreciate every one of you loyal listeners. Some have been listening for years. whether it's to our radio show and our TV show and our podcast. We have people that are going back many, many years, and we hear from them. If you have any questions, you can certainly email us, and we'll try to deal with them here. For Professor Plum, hey, thank you, Rick.
Hey, no problem.
It's great to have you back, and it's great to be back in this seat.
You're the one that's back.
I am back, but it's good. It's good to be sitting here with you one more time. For Professor Rick Plum, certified financial planner professional, I'm your podcast host, Johnny Dean. Thanks so much for listening, and we'll talk to you again next time. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. To the extent that this material concerns tax matters, it is not intended or written to be used and cannot be used by a taxpayer for the purpose of avoiding penalties that may be imposed by law. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the information presented serves as the receipt of or a substitute for personalized advice from Lucia Capital Group or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. The information contained herein does not constitute an offer to sell or a solicitation of an offer to buy securities. Investment products described herein may not be offered for sale in any state or jurisdiction in which such an offer, solicitation, or sale would be unlawful or prohibited by the specific offering documentation. S&P 500 Index is an unmanaged index and includes a representative sample of large-cap U.S. companies in leading industries. An investment may not be made directly in an index. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. CDs are FDIC insured up to $250,000 per depositor per insured bank for each account ownership category. It is important to keep in mind that investments in fixed income products are subject to liquidity or market risk, interest rate risk, bonds ordinarily decline in price when interest rates rise and rise in price when interest rates fall, financial or credit risk, inflation or purchasing power risk, and special tax liabilities. Interest may be subject to the alternative minimum tax. Treasury securities are backed by the full faith and credit of the U.S. government, but are subject to inflation risk. Rick Plum, Jonathan Savona, Janine Stripe, Terry Keys, and Preston Schumacher are registered representatives with and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.